And let's go across. We have Arul Selvan, who's the president and CFO at Cholamandalam Investment and Finance, joining us this morning. Mr. Selvan, always great having a conversation with you, especially on the back of a repo rate cut. You've guided for a 10 to 15 basis point increase in your margins for H2 FY26. Does this repo rate cut give you better visibility, or does it give you the comfort to enhance your margin guidance for H2? Your margins were at 7.7 in H1. I believe that the 10 to 15 basis points increase is versus H1, or do you expect the Q2 number, which was at 7.8%, to be the base for that 10 to 15 basis point increase? Give us a sense of that as well.
Yeah, morning. So yes, we will see some more improvement is what I believe, and we should see another 5 to 10 basis points moving up. But whatever numbers I've been talking is on a year-on-year basis, so kindly look at it from that aspect. So we will overall for the FY25 versus FY26 should see a movement of at least 25 to 30 basis points improvement in the cost of fund. I'm just making it clear that it is on cost of funds, and the NIMs can differ because we have a wide product mix where, we will have products which are in the lower end of the yield curve versus some certain things which are on the higher end. The reduction in cost of fund would enable us to go into products which are on the lower end of the yield curve, like heavy commercials, etc., which will have a positive impact on the OPEX and the NCL. So we may not see this reflecting in NIM, but it will certainly go through and reflect in the ROTA.
Okay. So suffice to say that we can see a 10 to 15 bips improvement in your margins in the second half of the fiscal?
Certainly, you'll see this continuing, yes.
Will you pass this on, Mr. Selvan, this 25 bips repo rate, will you pass it on to your customers?
See, all of this 25 basis points repo rate does not translate to us because our exposure in repo rate borrowings is less. It is only 25% of the overall borrowings. So to that extent, there is a benefit. But again, from a passing on aspect, we will be passing it on those loans which are of a floating rate nature rather, and because the large part of our book still is on a fixed rate, like vehicle finance, SBPL, etc., which on which there is no need to pass on. The pass on would happen more with regard to the marginal borrowings.
Mr. Selvan, I'm trying to understand whether for the fresh loans that you're booking, are you passing on the 25 bips rate cut to your customers or not? And what does that therefore do to your growth? Is there a positive surprise expected? You had earlier guided 20 to 25%. You've at the end of Q2 guided 20%. Does it give you that tilt to go above 20 now that there's been a repo rate cut as well?
See, the passing on we are talking about the AM growth. So that right now, let us keep it in the same 20 to 22, 23%, guidance we have given earlier. We will certainly be there. On the passing on aspect, it also depends on competition and, the other aspects. It's not like, a commodity sale. Here we need to look at the underwriting strength and then look at the collection ability over the tenor of the loan. So it is not like immediately can be factored into to be passed on. So we have to look at the market, we have to look at the underwriting, process, and then see how much can be passed on.
I want to talk about your gold loan book. Tell me, how many branch additions are you looking at, and what exactly could the loan book equate to by the end of the fiscal?
See, we right now are operating, as we speak, from 120 branches. Q2, we were at around 113 or something, but now we have moved it up to 120. We will progressively be moving this up over the next few quarters also. And we have certain plans. Right now, I don't want to divulge any numbers on the growth of the branch counts. The fiscal of this year, we should close it at around 1,000 crores of AUM on the gold.
Okay. All right. Can you also, Mr. Selvan, give us a sense with regard to how the demand is shaping up for you? I know you've guided 20 to 22% growth, maybe even 23 is what you indicated. But talk to us about demand trends playing out and the sustainability of this demand. GST rate cuts have come into the system now. That's been well accepted. You'll have a better ear to the ground to give us a sense as to whether the kind of loan growth we're seeing is sustainable or not into FY27 as well.
Yeah, we saw good growth in October, and while it moderated a bit in November, it still was a better growth than the previous years or the pre-October disbursement growth. The growth will be happening. The GST cuts will enable growth or translate into immediate growth into more consumer-oriented products like our passenger cars, two-wheelers, and then the CD part of our book. The growth in regard to the CV part or the tractor and the construction equipment part would come only as and when there is a demand in the market for these products or the borrower wants to go for replacement or new creation. Right now, we are not seeing that much of a traction on the CV. The other aspect is the GST cut is here to stay. So there is no rush to go and buy any product which is not immediately required, and they will wait as and when the requirement arises, they will go for this purchase. On the future, we see demand going up, or we see disbursements going up in Q3, Q4 because of the seasonality part. But we are little, right now not so clear about whether this cyclicity and the seasonality part will impact the Q1, Q2 of the subsequent financial year. But if it holds good, then we should see improvement continuing, because then the outer cycle would have turned and we would be seeing we'll be able to leverage the cycle movement back into positive territory.
Right. Mr. Selvan, I want some color on how asset quality is panning out for you. Because from what we understand, there have been rising delinquencies in states like Odisha, MP, etc.
The asset quality always goes through, especially in those states which you are referring to, in the monsoon quarter, which is the Q2. Because mines are closed, then the roads are not, transport cannot work, and there is a lot of repairs and maintenance that creeps into the earning potential of the borrower. So these quarter, that is the Q1 and Q2, are always a dull quarter. This is the seasonality part I was talking. Harvest also happens post that. So large part of our business is focused on rural. So there our collection does suffer during Q1, Q2. Q3 and Q4, you'll see improvements because festivities come in and then harvesting happens. And so you will see more traction on utilization of vehicle, thereby improving the earning potential of the customers. So we are confident Q3, Q4, we should see reversals in our loan losses, especially in the vehicle finance book. The mortgage book had been holding good on the credit side. There has been no major concerns. The other aspect of credit cost increase is in the unsecured book, where we have done some corrections on the fintech exposures. That correction pain will continue for another 1 or 2 quarters, but post which the fintech book would run down fully. So there should not be any major impact thereafter.
Mr. Selvan, the last time you spoke, you indicated that your ROA might be on the lower end of the band, right? You had guided for around 3% in terms of ROA, and your PBT ROTA, if I recall right, was around 3.5% in terms of that was the target. Do you believe that there could be some bit of upside surprise to that guidance, given the fact that you've got a repo rate cut now that is at play?
See, the PBT ROTA last year was a little lower at around 3.2%. 3.3%. So we will be around that, maybe improve on that to 3.3 to 3.4%. We will still not be able to touch the 3.5 for the full fiscal because the first half had been a little low on the ROTA. We are trying our best, but I just want to be cautious for the current financial year. Next financial year, if this rate benefits continue, which I am confident it will continue, and if the traction on the AUM growth happens as what I was explaining a little while back, then certainly we should reach the 3.5% pre-tax ROTA next year.
Okay. Mr. Selvan, just the last point with regard to CV and how that is behaving. I know Aisha asked you with regard to asset quality, but we have had maybe a little bit of commentary coming in, which seemed to suggest that CV may not be behaving as well as one would anticipate. Are you seeing absolutely any concerns on ground, or is it completely comfortable on your end?
No, as I was saying earlier, CV suffers during Q1 and Q2, especially the small road transport operator segment, which is a large part of our portfolio. Unlike fleets who will have a little larger, cash balances or their ability to get working capital funding, etc. So the SRTO segment suffers during Q1, Q2 due to the seasonality because of monsoons, inauspicious months, and thereby impacting their utilization levels. This turns around in Q3, Q4 when festivals start as well as harvesting becomes a positive factor for them. So that would certainly impact positively for us in the coming 2 quarters, which is Q3 and Q4, and we should see improvements in the credit cost.
Right. Okay, Mr. Selvan, great to have you today on ET Now. Thank you so much for your time as always.
Thank you. Thank you. Thank you.
Okay, let's take a very quick break on that note. When